Welcome to the 3 Edge Weekend Review for the week of March 18th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing the recent Fed meeting this past week and what we refer to as the Fed's HighWire Act as it considers when to begin lowering short-term interest rates. We refer to the decision as a balancing act because the Fed doesn't want to cut rates too soon and thereby invite a resurgence of inflation, but they also don't want to leave rates too high for too long and possibly tip the U.S. economy into recession. And of course, this decision is made trickier by the fact that monetary policy always operates with what Wall Street economists describe as a long and variable lag. The Federal Reserve's Federal Open Market Committee did meet this past week and, as anticipated, chose to leave short-term interest rates unchanged at between 5.25% and 5.5%, which remains a multi-decade high. But perhaps the most anticipated portion of the announcement was the release of what is referred to as the Summary of Economic Projections, which is where each of the members of the FOMC they put down not their predictions, but their expectations for the years to come in terms of economic growth, unemployment, inflation, and interest rates. And investors wanted to see whether the number of rate cuts anticipated for this year had moved from 3 to 2 based on recent readings on inflation, which came in higher than anticipated. In the end, although it was close, FOMC members are still of the mind that there will be 3 rate cuts in 2024, which is a relief to investors, and Fed Chair Powell's remarks after the meeting were also seen to be dovish. Investors interpreted Powell's comments as indicating, of course without being explicit, that he'd probably like to cut interest rates sooner than later. It was a big week for central banks around the world. In a long-awaited move, the Bank of Japan officially ended the era of negative rates by raising its short-term interest rates up to between 0 and 0.1%. Bank of England left interest rates unchanged, but as the Fed signaled that it's edging closer to cutting rates. And lastly, and somewhat of a surprise, the Swiss National Bank actually did cut short-term interest rates, signaling the monetary authorities' confidence in falling inflation. So, Steve, traditionally, central banks, like our Fed, have had one key priority: to control inflation. And so why do we now say that the Fed is walking a HighWire Act? Could you explain?
Yeah, so since 1913, when the Fed was created, the sole idea of the Fed was as a lender of last resort. In other words, they would be invisible behind the scenes, never to be heard from. And once in a very great while, when there was a tremendous financial crisis, then they would come in to support the market. That all changed more recently, ever since the crash of 1987, and especially after the financial crisis of 2008 and COVID. Fed has intervened in a very direct way in financial markets and continuously. So that's why we often find ourselves talking about the Fed, because they do have a big impact on the market. So unlike at their founding, when it was all about controlling inflation, stable prices, they now have 2 mandates. Stable prices or controlling inflation is one mandate, but full employment or avoiding recessions is the second mandate. So that's why we say that they need to have a balance between the two. Now, Wall Street is currently pricing in the market prices that they are going to be successful in this HighWire Act. But history does show that there are more cases of either falling to the bears of recession or falling into the fire of inflation than there are successfully crossing that high wire.
Okay, so in recent commentary, we discussed the outlook for the markets in terms of 3 potential scenarios. So maybe could you help us think about how the Fed's recent pronouncements may impact these 3, frankly, quite different potential scenarios for the economy and the markets?
Yeah, and just to quickly review, scenario 1 is the economy grows higher than expected, interest rates stay higher for longer. Scenario 2 is the Goldilocks scenario, where inflation comes down, interest rates come down, but the economy grows sufficiently to keep employment full. And scenario 3 is that the Fed trips up on the HighWire Act and falls one way or the other, and we end up with a hard landing and a big correction. So those are the 3 scenarios, and they're all still possible, despite what some might say, in our opinion. However, I would say that Wall Street cheered because they seem to be following the script of scenario 2, where despite the fact that we've had some recent inflation readings that have been above expected, they dismiss that partly as maybe noisy data. They are allowing the inflation to come back to target over a much longer time frame now. They're allowing it to take a few years rather than having to all be this year. And that's giving them justification to favor fighting the recession and lowering rates. And so this could support a continuation of the economic growth, but it does risk a rebound in inflation and then a later subsequent hard economic landing longer term.
Okay, excellent. So my final question, as always, is based on what we discussed here today about the Feds walking a bit of a tightrope, if you will. What might investors think about doing in terms of positioning their portfolios in this environment?
Since they've shown a bias for wanting to fight possible recession and maybe giving more latitude to inflation, we think it's now particularly an important time for investors to make sure they have sufficient exposure to assets that would hedge against a weakening of monetary policy, that would hedge against the prospect of higher, longer-term inflation. And those assets would be gold and tips. And I know that recently we have reviewed our own 3H portfolios, and we've recently added to our gold position. And we do own tips across our gold portfolios. We want to provide sufficient hedge against this possibility. Equities could continue to rally absent some exogenous surprise that would knock the market down. But because of the overvaluation, we say it's really important to keep an eye on the exit door.
All right, excellent, great, thank you. That was perfect. Thanks for your insight. And so now, along with everyone else, we'll wait and see if and when the Fed will begin to lower rates here in 2024. So that will do it for Steve and me for this week, but we will be back again next week with another edition of the 3Edge Week in Review. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who you think might enjoy or benefit from our videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.